hope you all are doing really well and are in best of your health, both physical and mental. This is Ritika and we are doing corporate issuers. We are now starting with the learning outcome 2 of this reading, that is organizational forms, corporate issuer features and ownership. And this LOS requires us to describe key features of corporate issuers. So we will begin this video by discussing what are some of the main features of a corporation. And the main features of a corporation are: corporations have legal identities separate from their owners. This means that they have rights and responsibilities like any other individual, and this other individual is not the owner himself. This feature therefore allows the corporations to enter into contracts, borrow money, hire employees, pay taxes, etc., like any other individual can. Then corporations are also subject to jurisdictions depending upon the geographic location where the company is incorporated. So if a company is floated in US, it is subject to jurisdiction or laws applicable to any individual in US. Second, corporations are also subject to jurisdictions at the place where the business is conducted. So a company may have been floated in China, but if it has operations in US jurisdiction will apply to the company. Then, companies are also subject to jurisdiction at the place where the company receives its finance from. So, a company may be floated in London and it is operating in Australia. But if it has a source of income coming from US jurisdiction will apply to it with respect to taxes, etc. Then these jurisdictions could state the rules for, or these jurisdictions may be related to registration laws, reporting and disclosure of financial statement and other required disclosures, capital market activities such as issue of shares, share trading, investment in applicable jurisdiction. Now the second feature of a corporation is its owner-manager separation. What this means is that there is usually a marked separation between the management and ownership of a corporation. The owners and the managers of a corporation are often not the same people. The shareholders are the owners of the corporation, and managers are those people who manage the corporation. The shareholders appoint the board of directors through a vote in general meeting, who in turn appoint the management. The voting rights of the shareholder are attached to their shares. Generally, each share carries a single voting right. Now, how are the managers appointed? The board of directors appoint the executive level management. The executive level management is responsible for activities of the corporation such as investment, finance, operations, etc. This means that for everything that's happening in the company, management is responsible. Of course, BOD is also accountable because they appoint the management. Then what are the responsibilities of management? The management is supposed to work in the best interest of the owners and all the other stakeholders. Why? Because if shareholders get offended, they can exercise their voting rights to change the management. Now, since the owners are not responsible for the management of the business, there can be unlimited number of owners. Of course, depending upon the authorized capital of the business, which obviously can be increased. Now, this allows the corporation to raise a large amount of capital, offering a huge growth potential to these corporations. Moving on, what are the liabilities of owners or shareholders of a corporation? These corporations are generally limited liability entities. This means that the liability of the owners is limited up to the amount of capital invested by the owners. In case of bankruptcy, the owners are not liable to pay anything from their personal assets. And on a downside, the prices of the shares will only fall up to zero and not any further. So if you have invested in a share when, say, the price of the share was $10, you purchased, say, 100 shares, the maximum loss that you can suffer is $1,000, not more than that. The shareholders are not responsible for the debt of the company. However, if any shareholder has specifically undertaken the guarantee of debt, then they would be liable for the same. So sometimes when a company is looking forward to raising money through bank loan, etc., if there is difficulty getting the desired loan, some major shareholders may provide a personal guarantee. And this guarantee states that in case of default by the company, the money up to the limit as specified in the guarantee agreement can be recovered from the personal assets of that shareholder. And since the capital of most corporations is divided into shares of smaller unit size, the risk and return on these shares is widely distributed. Some corporations issue shares of different classes with different risk and return characteristics. Like there are common equity shares, then preferred shares, then there are convertibles as well. Next, what are the major sources of finance for a corporation? So there are two ways in which a corporation finances its operations: equity and debt. Equity is financed either through the issue of shares or through reinvestment of profits. So when a company, instead of distributing the profits as dividends, retain the earnings, it is also a part of the equity of the corporation. And equity investors receive returns in form of dividends and capital appreciation. Debt finance can be obtained through loans, issue of bonds, leases, etc. The debt is usually repaid along with the pre-specified interest in the intervals as agreed in the terms of debt. Debt may have lien over the assets of the company, which are presented as collaterals. Now, both debt and equity can be divided into smaller tradable units by the corporation called shares or bonds, and both these shares and bonds could be of different classes. These instruments are traded in the secondary market or stock exchange. Investment in these instruments is usually made by individuals, institutions such as mutual funds, pension funds, banks, governments, etc. Lastly, how are the corporations taxed? The taxability of a corporation depends on the jurisdiction to which these corporations are subject to. We have discussed the jurisdictions earlier. The tax regimes of corporations vary from country to country. Different countries have different ways in which they tax the corporations, different rates, and different subsidy rules. However, in most countries, the corporations pay taxes on their profits. Sometimes the tax is also payable on distribution of profits or dividends, called dividend distribution tax. This also leads to double taxation because these companies have already paid taxes on the profits and now they have to pay taxes on distribution again. But in some countries, the individuals receiving these dividends are not supposed to pay taxes on dividends received if the corporation has already paid the tax at the time of dividend distribution. Though double taxation increases the burden of taxes on corporations, which is not in the case with the firms, the company structure is still the preferred form of business entity, especially if the business requires a large amount of capital that cannot be provided by individuals or small groups of investors. One person or a small group cannot provide the capital which a large crowd can, unless of course that one person is a really big gun. Let's do a couple of questions now. Here's the first one. In which of the following situations does the double taxation of corporate organizational form matter the least? A. The company expects to pay all its after-tax income as dividend to the shareholders each year. Well, in this case, double taxation would matter because first there will be payment of dividend distribution tax at the time of payment of dividends, and then dividends will be taxed in the hands of investors as their personal income. B. The company's shareholders reside in a tax jurisdiction with high tax rate on dividend income. For the same reason, here also double taxation would matter. In fact, because the dividend distribution tax rate is high, it would matter even more. Then C. Company is expecting to reinvest all its after-tax profits each year into the growth of the business. This is the correct option. Since there is no distribution of dividends, there is no taxation. Moving on to the next question. Corporate issuers are characterized by all of the following except A. Corporate income is taxed at both corporate and personal level. This is true. B. Owners do not need to be involved in the management of the company. The company is managed by the board of directors appointed by the owners. Then C. The owners of the corporation are not legally distinct from the corporations. They are legally distinct. In fact, they are considered as a separate legal entity. Therefore, this option is correct. That's all with this learning outcome. We'll start with the next learning outcome in the next video. Till then, keep learning and stay healthy. For detailed study notes and practice quizzes, check out our website procfa.com. See you with the next video.